Good afternoon and welcome to this webinar, which is on tax for the construction sector. I'm just going to wait a couple more moments as people join. I can see the numbers going up. Good, we'll make a start. So, as I said, good afternoon everyone and welcome to this seminar on tax for construction sector. My name is Paul Fenner. I head up construction sector nationally for BDO. I'm also part of the real estate team. Just a bit of news about the construction sector generally. It's had a rather bumpy journey over the last few years, certainly over the last couple with the pandemic. But we're also seeing now cost inflation and recently the war in Ukraine and energy costs at the highest ever level. The sector got pretty much back to pre-pandemic levels back in November 20, and it pretty much has stayed there since. Some subsectors have struggled, such as commercial, for example, but others have done actually really well, such as infrastructure, residential house builders, and repair and maintenance. Recently, we're seeing some key challenges in the sector around material shortage, price inflation, managing the supply chain, and the resilience of subcontractors. We saw ESG and carbon footprint, climate change, all risen up the CEO's agenda. But with recent cost rises and material shortages, these are now potentially second to that of survival. The sector has had to really change and move with the times. We've seen increased investment in technology, innovation, and some of the construction solutions now being offered. The concern though, and the worry is that there are still uncertain times ahead. We've got an excellent panel of tax specialists who work specifically and focus on our construction clients. Richard Dalton, partner in our VAT team, he will cover off an update on reverse domestic charge and other VAT changes. We have John Chaplin, who's a partner in our employment taxes team, and he'll make clear some of the changes proposed to staff-related costs. Conor Mansfield, senior manager in our R&D team, he concentrates on tech and innovation clients, but really key on finding funding back from the taxman. And Vincent Wood, a partner in our corporate tax and advisory team, he'll cover off all the other taxes around the construction sector, particularly following up on the spring budget, the Chancellor's spring budget changes. He'll also cover off the impact of residential property developer tax and plastic packaging tax. So the plan is we're going to open up the floor for questions after the presentations. So please use the Q&A chat function in Zoom to submit these questions to our speakers. If you've got any technical difficulties along the way, please also use the same chat function and we'll try and help you to rectify any issues. Please note, there's no need to make notes. We'll send you a copy of the slides and there's also a recording of the webinar which will be circulated to everyone after. I'll also take this as a time to ask you to also register for our next webinar, which is likely to be held on the 26th of April. Well, it is going to be held on the 26th of April. And that is really looking at the key findings from our construction survey 2022. So look out for LinkedIn and emails on this. We'll also aim to get a construction report out after that webinar sometime at the end of April. So thank you, and Richard, over to you.
Thank you very much, Paul. As Paul has mentioned, it's on the slides. My name is Richard Dalton. I'm a VAT partner. I specialise in real estate and construction. The purpose of today's presentation on the VAT side is really to talk about the domestic reverse charge for building and construction services. Not particularly new, it's been in for a year, but what I'd like to do is to very quickly take you through what it is, how it applies, but then focus on the impact that we're seeing it having, the approach that revenue and customs are taking, and what we think businesses should be focusing on in order to remain compliant. So, Lara, thank you very much. So, what is it? So, after two previously announced delays, it came in the 1st of March 2021, so it's been in for just over a year. There's lots of guidance, lots of kind of ways in which you can find out about kind of how it may impact on you. Essentially, what it's designed to do is to combat missing trader fraud in the construction sector. So what is that? Well, the way in which Revenue and Customs perceive the risk, the way in which Revenue and Customs see this as applying to the construction sector is historically VAT would have been charged from supplier A to supplier B. Supplier A would have charged VAT. Supplier B would have recovered that VAT and as input tax, and supplier A would have charged it as output tax. The risk that Revenue and Customs saw is that supplier A could be taking that VAT and absconding with it. So what the reverse charge is going to be doing going forward is going to, or from 1st of March last year, is it will be supplier A doesn't charge supplier B VAT. What it does is it just tells supplier B what the VAT it would have charged would have been, and supplier B then self-accounts, charges itself VAT, and then recovers that VAT on the on its own VAT return. So next slide, please, Lara. Where does it apply? Well, it applies if the recipient is VAT registered and registered under the CIS, then it applies. But it must also confirm that it's an end user. So, and if it doesn't confirm it's an end user, then the supplier must charge VAT. Next slide, please. This is a list. This is more for education after the event of the things that it applies to. I thought this would be useful. Next slide, please, Lara. So it only applies whether it's standard rated at 20% or reduced rated at 5%. Clearly, it doesn't apply if it's 0 rated. And it can apply to associated goods and materials which fall to be treated as part of a single supply. Next slide, please, Lara. This is really the focus that I wanted to kind of have in the next 5 minutes or so. I mentioned that if you don't opt taxes, if you don't opt to be the end user, what does that mean? Well, what that means is that your supplier will ask you 3 questions. Firstly, what does are you registered for CIS? Are you registered for VAT? And are you an end user? If you don't give if you don't confirm that you are an end user, then technically the person making the supply to you should not be charging you VAT. Why would that be beneficial? Well, throughout the supply chain, the domestic reverse charge creates a problem with cash flow. So whereas supplier A used to receive the VAT from supplier B, it no longer does that, and that means that there's an impact on its cash flow, because it would have been able to use that VAT as working capital. All the way through the chain, that happens until you get to the end user. If the end user doesn't, if the end user doesn't confirm it's an end user, then it doesn't get charged VAT, and it has to account for VAT under the reverse charge, which creates a cash flow benefit for it as the end user. That could be significant, but it's at the expense of some administrative charges and some administrative issues around changing the way in which your systems work. So when this first came out, Revenue and Customs, it wasn't clear from Revenue and Customs whether or not this was genuinely an option, whether you could opt to be regarded as an end user. It's now clear that you can. So that's something that businesses should consider doing, consider whether or not that's beneficial for them. The key thing that we're seeing, though, and the key thing I wanted to flag as part of this, is that the way in which Revenue and Customs are now looking at this 1 year on is we're seeing lots and lots of clients having a situation where Revenue and Customs are asking them, for example, where they have submitted a VAT return with a repayment on it, we're seeing lots of examples where revenue and customs are saying, well, this repayment is VAT that's due on construction services that you've received. Did you confirm that you are the end user? If those suppliers are unable to confirm that they were the end user, then revenue and customs would be within their rights to assess for VAT that's been incorrectly charged. Now, what we're being able to do is we're being able to work very closely with clients and kind of navigate through that discussion and that debate with revenue and customs. But it's one in which we see there being scope for lots of issues in kind of going forward. This is particularly the case where if you think about the interaction with making tax digital, where it's now important to have a full audit trail through the entire invoicing system. So the interaction between making tax digital and domestic reverse charge for VAT is one that we see having a significant impact in the construction sector, which I mean, these are two quite broadly speaking difficult sort of technical and administrative aspects that wouldn't be at the top of most people's agenda when they're thinking about the way in which to operate their business in the hard times that Paul has outlined. So what we have is we have a bit of a perfect storm, really. You have the impact of cash flow that domestic reverse charge introduces, negative impact throughout the supply chain. You have the optionality or not of being an end user, and then we have revenue and customs after a year now reviewing VAT returns, and specifically large repayment VAT returns, and asking businesses to ensure that they have put in place all of the things that they need to do in order to be running this properly. And what we're seeing is a lot of people are kind of, to a certain degree, unaware of their responsibilities, which is the reason for the slides that preceded this one, to kind of just remind on the key points. Add into that the fact that from April this year, all VAT returns will need to be have digital links, and what you actually have is a real need to kind of take a step back, review your accounting processes, review the training that your staff have, and make sure that you are as up to date as you possibly can be in relation to how VAT in the construction sector works, and making sure that the impact on your business is as minimal as possible. Thank you very much.
Thank you, Richard. Sorry, I'm having problems with the IT then for a moment. So, good afternoon, everybody. My name is John Chaplin, and I'm an employment taxes specialist within BDO. Can I start by saying Happy New Year? It's not the Happy New Year that we perhaps normally get, which is the popping of champagne corks and singing round a fire and wishing well to everyone. This is the new tax year, and I'm afraid that with most new tax years, what that does is add extra work for most organisations, and particularly employers, and a lot more complexity in terms of how they have to tackle employment taxes compliance. So over the next couple of slides, for the next 8 minutes or so, I just want to give you an update on some of the things that are going to be changing with effect from today and beyond, and also just have a look at a couple of risk areas for the construction sector, and give you some flavour in terms of how you can hopefully stay the right side of the compliance line on those points. So next slide, please. I hope that if I mention off payroll labour and IR35, there's almost a little bit of a sigh, if not out loud, at least subconsciously, because I really do hope that you are fully aware of everything that's been happening around off payroll labour and IR35 for seems to be years now. But the reason for mentioning it today is relatively straightforward, in as much as the changes were implemented with effect from 6th of April last year, having been delayed by a year in the private sector. But HMRC at the same time gave effectively a soft landing period of 12 months. The bad news is that soft landing period has now expired with effect from today. So whilst it was only a limited soft landing, as much as if you got it wrong, there were liabilities which were still attached to it, but there were no penalties. Now I'm afraid the liabilities still remain and the penalties come back on board. Now, why is it a biggie? Well, I've done employment tax for more years than I'd like to think, to be perfectly honest. And throughout my entire career, what we now know as off-payroll working has been the #1 risk from an employment taxes perspective, particularly in the construction sector. That includes self-employed, agency, temp workers, and the like. But for the moment, let's just have a look at IR35. Just to put it into context, for every £1 you spend on off-payroll labour, the potential tax risk I would estimate is about 50p when you include potential penalties and interest and other bits and pieces on top of that. And they can go back at least 4 closed tax years. So just to put it into context, if annually you are spending, let's say, £1 million in respect of off-payroll labour, then you're running a risk of about £2 million, maybe a little bit more depending on your historical practice. So it's a biggie, and lots of construction businesses can have in HMRC questioning them from time to time, and therefore it still needs to be dealt with, I'm afraid. Add to that, we've got the National Audit Office and Finance Bill Subcommittee reporting on how it was implemented in the public sector, saying it was all really easy, and the private sector have had a couple of more years to get used to it, so they should find it even easier. The reason for mentioning that is, I think, from an HMRC perspective, don't expect any sympathy or any easements if they believe that you've not operated off payroll working labour rules appropriately. It's also led to an increased focus on alternative models, particularly in the contracting space. Umbrella companies have come to the fore, and usually it's a little bit like whack-a-mole, I'm afraid, that once one problem gets solved, another one pops up over to another side. So you'll have seen, I'm sure, lots of things in the press around holiday pay to umbrella employees or mini umbrella company schemes whereby they're making use of various models which HMRC don't like and are trying to close down, etc. So just be a little bit wary that moving from one element, i.e. IR35, fixing that might also cause things to pop up later on down the line. HMRC have been a bit quiet around off-payroll labour for the last year or so, and the reason being that is that most of their staff have been dealing with COVID compliance and the CJRS scheme. Those people are now coming back onto employment tax compliance in the general sense of the word, and we're starting to see lots more activity. Linked into the end of the soft landing period, I'm sure that's going to give them more to go at. So I think now's a good time to do what we would always suggest, but certainly now is probably a better time than most. And that is to have a look at what policies and processes you have in place. Are they still fit for purpose? Do they do what you need? Would they stand up to scrutiny? And probably what we're seeing in your sector in particular is, are they actually still indicative of what you do? So we're starting to see some organisations now try and take a softer approach in terms of the compliance issue around IR35. Maybe because it's cost driven, maybe it's because it's supply and demand. They can't get workers to come in under, dare I say it, safer schemes, employment relationships or whatever. So they're having to take more of a commercial risk around off-payroll temporary supply workers. Now's a good time, I think, just to pick it up, because if you don't in the next few months and next couple of years in particular, I think HMRC may come and ask you those questions. Okay, next slide, please. Just a few little bits and pieces in terms of changes which go live mainly today. You'll have seen in the spring statement the announcement around employees' national insurance changes to the primary threshold coming in from July 22. You'll also know the rise of 1.25% in employers' national insurance, etc., coming in with effect from today in advance of the social healthcare levy being introduced this time next year. I don't propose to go into lots of detail on that one, but just to say you've got 6th of April changes, you've got July changes, you've got special rules which relate to directors' annual earnings periods. I would, if I were you, just check in with your payroll people to make sure that they're all over it and that they know what the rates are and the systems have been changed, because if they go wrong, it can add up to a big issue that A, is large liabilities, but also takes a lot of unravelling beyond the date. The employer's allowance for smaller businesses has been increased now to £5,000. So on the surface of that, if you're a small business, that's good news. The downside slightly is that that's opening up an extra incentive for some people who are looking to use the employment allowance in a way which HMRC never intended it to be using. So in other words, we've seen a few instances of businesses splitting their companies into a collection of smaller businesses, not you guys, but maybe some of the suppliers if you're not careful. So just make sure that when you are contracting with a small supplier, they're not part of a large group, and they've just been set up to potentially do something naughty around the employment allowance that they could claim. Home working equipment, you'll hopefully be aware that HMRC gave some tax easements to cover COVID. They now end, so from today onwards, you don't get the same tax relief for provision of equipment. Now, what do I mean by that is it goes back to the old rules. So in order to be able to get tax relief on, say, a desk or a chair or even a laptop or whatever provided to work from home, you have to carry out substantive duties at home, and the employee has to carry out those duties at home. So with everything that's happening beyond COVID and going forwards, lots of organisations are looking at flexible working, where they may allow employees to work in different locations as it suits everybody. That might not be enough to qualify for the tax relief on any equipment that you want to provide them with, for example, from working from home. So just be a little bit wary of that and maybe revisit your policies. Similarly, if you've got people working flexibly, certainly within the construction sector, it's always been a big issue, but HMRC are gearing up now post-COVID to look at traveller's assistance claims because people who are maybe working at a site, that might be their normal place of work. It might not be that they are away from their normal place of work. So I think it's definitely a good idea to look at working practices and make sure that your expense claim procedures, your policies, your staff training, and even your contracts for employment fit comfortably with all those. Conscious of all that could be potentially negative news. So a couple of little bits of positive news. Obviously, hopefully you'll be aware of cycle to work exemptions where people can get tax advantaged cycles as a result of being supplied for their ordinary commuting. What is ordinary commuting now is an entirely different kettle of fish. So if people are working from home, the argument is unless they get out of the back door, pick the bike up and ride it round to the front door, they're not really doing any commuting. So be wary particularly about new employees joining cycle to work schemes where they are 100% based from home, certainly. But electric vehicles are becoming more and more popular generally, not least now down to the fact that there is a benefit in kind of only 2% of the list price of the vehicle rather than significantly higher list price percentages in respect to fossil fuel burning vehicles. So don't be surprised if you get lots of employees, if you haven't already got a salary sacrifice in place, looking to introduce one for electric vehicles. I'm conscious of time, so I will hand over now to Connor to have a look at the R&D tax relief.
Thank you, John. Hopefully you can all hear me. Please let me know if you can't. So thanks for that, John. Thank you all for joining us today. So my name is Connor Mansfield, and I'm a Senior Manager within our Innovation and Technology Group at BDO. It's a specialist team at BDO, which comprises a mix of engineers and scientists working alongside tax experts and accountants to provide R&D incentives and patent box and grant funding advice. I specifically head up our construction sector team, which includes 10 civil engineers, and our focus, our client portfolio, is on R&D in the construction sector and other built environment sectors. So today I'm going to give you a bit of an update specifically on R&D tax relief, which has become a massive a larger focus area for HMRC in the last couple of years, after a relative period of not gaining kind of much attention or change in policy. I think that was until the relief featured recently on last year's budget, and also was touched upon by the Chancellor in the recent spring statement, where there's been reforms announced that are aimed at improving the return on investment of the relief, but also making sure a couple of other measures to make sure it's a bit more fit for purpose for the way that modern R&D is carried out. So if you could change the slide, please, Lyle. Great. So although the draft legislation, the details not out yet, and it's expected to be released in the summer, so far we know that the reforms that are proposed to come into effect from the 1st of April will include some of this that's on the screen here. So exclusion of non-UK subcontractor and externally provided worker costs. So it's looking like the line might be drawn by entity rather than geographically, which may mean if you're a UK company with UK branch workers, that could still remain eligible. And work is ongoing as well to iron out some narrow exemptions to this rule that kind of mean that where you have environmental or geographical or legal reasons or skills availability where that R&D can't be done in the UK, you have to seek maybe workers from outside the UK, that might still be allowable. Let's say if you're designing or building a building in some kind of challenging environmental condition like the desert or something, it might not be appropriate for you to be able to do the R&D in the UK. So this point here, I think, is quite an unsurprising change, considering we're kind of post Brexit now. I think it's aiming at ensuring the relief focuses on R&D, which really benefits the UK economy, and it kind of brings it in line as well with what is commonly seen with other reliefs, say in France and Canada and other countries where there's R&D incentives. So the second and third points, data and cloud computing, previously excluded, but some license payments and cloud computing costs will come into scope. Likewise, pure maths, previously excluded for in the relief up until today, or up to date, but that will now come into scope, and I think this is aimed mainly to boost sectors that are undertaking kind of R&D in the fields of AI, robotics, data, and manufacturing, for instance. So those three changes probably going to have relatively low impact on construction R&D claims compared to most other sectors. But clearly, if you've got non-UK R&D supply chains, this could reduce your claim. Good news is, if there's any, if you're increasing any investment in technology around data, manufacturing, AI, robotics, from next year, that will attract greater relief. The fourth area that's there is around abuse and enhancing compliance. So there's a raft of proposed measures to counter perceived abuse, particularly by kind of non-regulated rogue advisors, if you like. So this going to involve companies needing to notify HMRC in advance if they plan to make a claim. Not sure how that's what form that's going to take at this stage. Likewise, with a kind of digital process for our R&D claims, again, this is something that has been spoken about, I think, for many years, and it looks like it's finally going to be implemented. How this will look is yet to be finalised. There will also be, with any claim, with any submission, a senior officer at the company will need to sign off and endorse it as part of the submission, and any agent advice that's been fed into the submission will also need to be disclosed. So also a more recent announcement in the spring statement is that the RDEC rate, typically for larger companies, is going to be increased, but we think this is mainly just to offset. We'll see how much of an increase it will be, but it's likely just to offset the net benefit large companies, the impact on net benefit large companies will receive after the corporation tax rate rises to 25%. So that is what is coming into effect next year. But there have also been some changes in the background that already being felt that companies may would be wise to be aware of. So Lara, if you could move to the next slide, please. So as well as the reforms, there have been some other kind of immediate other measures taken by HMRC that over the last couple of years. So in order to enhance kind of compliance and a bit more scrutiny from them in regards to this relief. So a really substantial one is that there's been specifically 100 additional inspectors recruited to inquire into R&D submissions. So as you'd expect, this has been followed by a notable increase in inquiries into claims in the last year or two, and there are generally some themes that we've observed. At least we think there's some key kind of focus areas for these inquiries that we have observed. One area is project boundaries. We're finding that where, especially in this sector, in the construction sector, a lot of claims involve R&D projects being undertaken as part of a wider, maybe commercial project. So what we're finding is the revenue of really challenging whether or not you have ring-fenced the R&D element effectively from maybe wider commercial activity that is more maybe the delivery, the implementation of a project, and is not supporting the kind of the resolution of technological uncertainty. So that's a really key area, and one thing if you are making R&D claims, one thing to make sure that you're really assessing and defining well. Another area is contractual relationships. So R&D projects that feed into customer funded work should be carefully considered to ensure that the contractual relationship permits the nature of the contractual relationship permits your company to claim. So if you have been subcontracted to undertake the R&D, your eligibility to claim and at which rate of relief, i.e. the SME or the RDEC, the kind of large company, less beneficial rate of relief, will depend on the nature of that relationship. So likewise, similar to that, if you have R&D expenditure, but it's met directly or indirectly by an external party, so a customer or via grant funding, for instance, an example might be with a customer-led project where you have, for instance, maybe in construction, you might have a cost plus contractual arrangement. Then if you're an SME, the eligibility of that expenditure and the rate of that relief might be impacted in those kind of situations. So it is important to note here that the common interpretation taken to date is that a company being subcontracted to provide a deliverable or service and then undertaking R&D separately of its own accord in order to be able to deliver on this contract does not represent R&D being subcontracted. Likewise, if you have a kind of customer-led contract and there's no direct link between, if you're undertaking R&D and it overruns, that if that expenditure is not being met by your customer, then that would not be in those situations, that would not be R&D being subcontracted or your R&D being subsidized. But recently HMRC have been opening inquiries in these areas to kind of challenge claimants and make sure that they've really looked into and established whose R&D it is and with the appropriate rate of relief. So one of these, in fact, one of these relating to a construction contractor actually went to first tier tribunal recently, where they were delivering construction works or refurbishment works for a fixed price contract. HMRC's view was that that the R&D that they were taking separately was linked back to that payment, and it went to first tier tribunal. Tribunal actually ruled in favour of the claimant company, saying that actually there was no direct link between R&D expenditure and the payment from the company, which is what the common kind of interpretation is. So it's just an interesting area. It's really important more now than ever to ensure you're doing necessary due diligence around contracts and making sure that you're treating kind of any R&D spend in the right way. And if you do have measures in place, if you are doing that work, if you are trying to, putting the effort in to make sure you're compliant, be transparent and make sure you disclose this. You should be hopefully submitting some kind of supplementary information to justify your R&D claim. Disclose that you've looked at contracts, disclose that you've assessed the nature of the relationship. And then, of course, if you're still not fully assured and you want maybe a second opinion, speak to a specialist, speak to someone, a reliable specialist, to get that assurance that you're looking for. So that is kind of what the latest, I suppose, on R&D. And now I will hand over to Vince, who's going to cover some other areas of tax and some areas coming out of the spring statement.
Thanks, Connor. Who thought pure maths would ever be mentioned in a tax webinar? Is that the same as applied maths? I don't know. Anyway, first thing, we're going to look at the spring budget, and we're not going to spend any time on this. You can see the measures there. There weren't a huge number. I suppose the key kind of thing that struck me about this budget was, if you look at the number of measures and what they do, it's basically a tax giveaway. But it didn't feel like that, did it? It was, and that was, I guess, because of the national insurance increase. So in the end, it felt more balanced. So there's one list, and then another list of measures. So we're not going to dwell on those. I'm sure you've read about those. But what we are going to concentrate on is the three things. Next slides, Laura. Which are coming in or came in on the 1st of April. So all these three things came in on the 1st of April, basically. So we'll just touch on them all, just an awareness thing, really. Probably residential property developer tax, the main one, if we can look at that, Laura. Generally, this arose, there was a need to deal with the defective cladding and the government looking for a contribution from the UK's largest property developers, and that's sitting alongside the building safety levy. So it's time limited. It's intended to raise at least 2 billion, but over a specified 10-year period. The rate is 4%. That's in addition to the corporation tax rate, but it is subject to this 25 million group allowance. So that's why it only applies to the largest property developers, that each group of companies gets that allowance. So it targets corporate developers building residential properties on trading accounts. It's sort of buy to sell rather than buy to let. Now, there are lots of exclusions from the definition of residential property: purpose-built care homes, hospitals, temporary sheltered accommodation, hotels, certain student accommodation. There's a whole list. So this will result, won't it, in a rise in corporation tax from 2023, not just the 5%. So after that, effectively, developers will be paying 29% on their profits in excess of the group allowance. So next slide. The key aspects of this are that it applies to residential development, property development profits of a residential property developer. So when is a company a residential property developer? Well, it carries on residential property development activities. Now, that's probably a wider scope of items than you'd think. It ranges from design right through to marketing, if it's to do with that property development. Second one there, and this is about JV companies. So if basically you own 10% or more in a JV company as defined, which carries on a residential property development activities, then you can get an apportionment up the chain of 10% of the profits, or whatever the percentage is, and those profits will be subject to residential property developer tax. And an exclusion there for non-profit housing company, various social housing businesses. Second, really important point here is that you need to have an interest in the land. So the activity must be carried on or in connection with the UK land which the company has. Or for some early stage activities like design and planning, it can also apply if you previously had the interest in land. So an important point there. And finally, the land must be held as trading stock, which obviously it could be held as if it's fixed asset investments, not trading stock, then there's not a problem. So just next slide, just touching on some points to watch. And I'm just going to pick up a couple here. I think there's the allowance, really important to get the admin right, because you might have a big group, some of them subject to residential property developer tax and some not. The default position is to allocate it evenly, so you waste it. So make sure that that doesn't happen. Retrospective, so if you have a 31 March year end in, say, and you, sorry, 30 September 22 year end, and you completed and sold your development by the end of March, 6 months of that will be apportioned into post 1 April 2022, and therefore will be subject to this new tax. And next slide, Nora. Stock write-downs is one I'm going to mention there. Stock write-downs, if you've written down your stock prior to 1 April 2022, then when you come to calculate your profit subject to this new tax, you need to take the lower value. So there's a potential trap there. And just finally, their interest is not a deductible cost, and so company can suffer an economic loss, but still suffer RPDT. So that's it on residential property developer tax. Just an awareness then on plastic packaging tax. We're not expecting this really to affect construction too much. It's not in the front line of this, but the set out there are the basics. It starts on 1 April when charge applies when a chargeable plastic packaging component is produced in the UK or imported into the UK. Who's liable? It's the person who produces the component or the person on whose behalf the component is imported. And then finally, it's £200 per tonne, and there's an exemption there if the proportion of recycled plastic in the finished component, when measured by weight, is less than 30% of the total. So if it does apply to you for whatever reason, the thing we found most hampering companies in getting to the right sort of getting their head around this is getting the data, around those weights, the 30%, all that sort of stuff in the supply chain. So then finally moving on to the uncertain tax treatments. basically this is applies to only large businesses, and it's the revenue trying to get sort of more tax and knowledge of situations where companies have these uncertain tax treatments. So if you flip to the next slide, Lara, so it only applies to those large companies, applies to corporation tax returns, partnership returns, PAYE, VAT. And it only applies where you have this uncertain amount and there's a threshold. So finally, if you flip on to the last slide, Laura, not that one, yes, an uncertain amount arises. And this is the key thing. If you've got a provision in the accounts, well, you'll know that, won't you? So, because of the uncertainty, you've put a tax provision in. So that's one of the triggers. The other one is, and more likely, and will happen on many occasions, one would think, where the tax treatment relies on an interpretation or application not in accordance with HMRC's known view. So, what is that? There's a lot of discussion around that, and maybe a difficult one to judge. So yeah, there's a threshold. So all the tax advantages from all the uncertainties in a year need to exceed 5 million, and then there's a range of penalties there which do have potential to escalate. So that's all I had to say. So now we're going to just visit the Q&A. And I think if Richard, I don't know if you didn't notice, but Richard was actually getting thrown out of his room in his, or challenged in his piece. So hopefully he's settled now. And I don't know, Richard, whether you managed to beat off the marauders and can answer the question on the Q&A for me.
Yeah, sure. And apologies, I have beaten off the marauders. I've barricaded the room. I can never leave, but importantly, no one else can arrive either. So sorry for the kind of the slight interruption earlier. I've answered the questions in the Q&A, but I suspect people will have been quite kind of intrigued and engaged in what other people were saying. So I'll answer them both again. I personally don't. So the first question was whether or not, because of domestic reverse charge, one of the attendees, one of the delegates, has got into the payments and account regime. Now, for VAT, what that means is that instead of at the end of the quarter submitting a VAT return and paying your VAT liability, what you have to do is within the quarter you have to make 2 equal payments as calculated by Revenue and Customs using a formula, and then a balancing payment. And instead of submitting your VAT return on the 7th day in the month, kind of after in the second month after the end of your period, you have to submit your VAT return on the final day of the month following your VAT return period. So it's kind of bad news all round from a cash flow perspective. I personally don't have any clients who've fallen into the payments and account regime purely as a result of the domestic reverse charge, but I've got lots and lots of really good positive experience and positive war stories of Revenue and Customs being willing to engage in a discussion around the payments and account regime. So discussing what the interim payments should be, whether clients should be in the regime at all. So I would be very confident, given that in the public notice they invite people to contact them and discuss the payments and account regime with them. I'd be very confident of you being able to get a good result if you engage with them. And as with all things, engage with Revenue and Customs, full disclosure, early, make sure that you are as transparent as you can be. And I think I would hope that you would get a good result on
Excellent.
that.
If I can interrupt you there, Richard, yeah. I've just got one more question. If John, you can pick this one up. Apparently, you mentioned the risk of penalties if there are compliance failures with off-payroll workers, but we use a major agency to outsource all our temps and contractors. Will we still be liable if they make a mistake?
Thanks, Vince. I suppose the short answer, a typical tax consultant's answer, is it depends. There are lots of different ways that HMRC can attack labour supply chain risk, different legislation. So there's the agency rules, and we've been answering one on the chat around self-employed workers coming through agencies. There's the off-payroll worker legislation, there's managed service company legislation. Some of that legislation can transfer right up to the top of the supply chain to the end client. Most of it sticks at some point in the supply chain, the chain itself, usually at the person who's making the decision to hire the worker. So it does depend. The off-payroll legislation definitely can transfer through to the end engager if the end engager has given, want of a better phrase, wrong information to the person making the status decision around the worker. So if you've given duff information to an agency and the agency's relied on that information and got the decision wrong, then that liability can be transferred up to the end client in that example. So the short answer is it depends. The longer answer is it's very complicated, and you probably just need to make sure you've got the appropriate controls and process in place to protect you and make sure your supply chain are protecting you as well.
Okay, I was going to ask Connor a question on pure maths, but we don't have time, unfortunately. Thank you all for attending this webinar today. And as Paul says, there's more to come. If you'd continue using the question and answer facility for the next few minutes, that would be great. And then we'll get back to you individually. But thank you all for listening.